There's a financial system larger than all the banks you've ever heard of combined. It doesn't have branches, it doesn't take deposits, it's not regulated like banks. And most people don't know it exists. This system, called shadow banking, controls approximately $70 trillion in credit-focused assets, according to Financial Stability Board estimates. That's roughly the size of the entire global GDP. These aren't illegal operations or underground markets. They're hedge funds, private credit companies, money market funds operating in plain sight but beyond traditional banking rules. They lend money, create credit, move trillions daily. And when they fail, as parts of this system did in 2008, the entire global economy nearly collapses. Welcome to the shadow economy. The parallel financial universe that makes your bank look like a corner store, the invisible empire that actually runs the world. The term shadow banking sounds ominous, like something criminal happening in dark alleys. The reality is more mundane, but far more powerful. Shadow banks are non-bank financial institutions that perform bank-like functions, providing credit and liquidity without being subject to traditional banking regulations. They don't hold federally insured deposits, they can't borrow from the Federal Reserve's discount window during crisis. But they can lend, they can leverage, and they can create the same kind of systemic risks that brought down Lehman Brothers. According to the Financial Stability Board, the global watchdog monitoring financial stability, the broader shadow banking system, technically called non-bank financial intermediation, held approximately $239 trillion in assets as of 2022. That's nearly half of all global financial assets. Within that massive total, entities specifically focused on credit provision, the ones that directly compete with traditional bank lending, control approximately $70 trillion. To put this in perspective, that's larger than the GDP of China, the United States, and the European Union combined. The shadow banking system didn't always dominate. It exploded after financial deregulation in the 1,980 seconds and 1,990 seconds. But the real acceleration came after 2008. You'd think a financial crisis caused partly by shadow banking would have shrunk the sector. Instead, regulations designed to make traditional banks safer pushed more activity into shadows. Basel III rules forced banks to hold more capital against risky loans. Dodd-Frank banned proprietary trading. These reforms made banking safer but less profitable. Money flows to profit. So, money flowed to entities that could do what banks couldn't: lend aggressively with less capital, trade riskily without Volcker rule restrictions, and operate globally without coordinated oversight. The numbers tell the story. Hedge funds collectively managed 15 times more assets in 2025 than they did in 2008, according to analysis from multiple financial sources. Private credit, a subset of shadow banking, where non-bank entities make loans directly to companies, grew from negligible amounts before 2008 to approximately $2 trillion globally by 2025. Money market funds, another shadow banking component, hold trillions in short-term corporate and government debt. None of these entities can be traditionally run like a bank where depositors withdraw funds, but they face liquidity risks that function similarly. Here's what makes this system powerful and dangerous: interconnection without transparency. Traditional banks must report to regulators. They face stress tests. Authorities understand their exposures. But hedge funds, private credit vehicles, they operate in shadows. A regulator can see that Bank of America loaned $5 billion to hedge funds. But what those hedge funds did with that money, how leveraged they are, what positions they've taken, that's opaque. It's estimated that American banks have loaned over $1 trillion to shadow banking entities as of 2024. What's unknown is the cascade of obligations beyond that first transaction. Citadel, one of the world's largest hedge funds, managing approximately $65 billion, doesn't have JP Morgan's $4 trillion balance sheet, but it has comparable, possibly greater, power to move markets. Citadel and similar multi-strategy hedge funds borrow massively to amplify returns. Current data suggests these funds operate with average leverage of about $12 of debt for every $1 of equity, the highest ratios on record according to U.S. Treasury data. When such highly leveraged entities suddenly need to sell, markets can't absorb the volume. Prices crater. Other leveraged players face margin calls. Forced selling accelerates. Contagion spreads. This isn't theoretical. March 2020 provided a preview. When COVID panic hit, hedge funds unwound massive positions in U.S. Treasury bonds, supposedly the safest assets on Earth. The forced selling was so violent that Treasury markets, usually the most liquid in the world, seized up. The Federal Reserve had to purchase $1.6 trillion in treasuries in weeks to prevent total breakdown. The Fed became lender of last resort not to banks but to shadow banks, though unofficially. This pattern repeated in April 2025 when tariff-induced market chaos triggered hedge fund deleveraging that sent bond yields spiking and stocks plunging. Let's break down the key components of this shadow empire. First, hedge funds. These aren't the small boutique operations they once were. The industry has consolidated. The top 10 hedge funds more than doubled their repurchase agreement borrowing since 2023 to $1.43 trillion, according to Office of Financial Research data. Repos are short-term loans secured by assets. Hedge funds post treasury bonds as collateral, borrow cash, use that cash to make leveraged bets. When bets go wrong or collateral values fall, lenders demand more collateral or cash. If hedge funds can't meet these margin calls, they must sell, often at losses, triggering the cascade described earlier. Second, private credit. This has become one of the fastest growing shadow banking sectors. Traditional banks, constrained by regulations, retreated from certain lending markets. Private credit funds, backed by institutional investors and wealthy individuals, stepped in. They lend directly to mid-sized companies, real estate projects, leveraged buyouts. These loans aren't as liquid as securities banks might hold. If private credit funds face redemptions where investors want their money back, they can't easily sell loans to raise cash. This maturity mismatch where short-term liabilities fund long-term illiquid assets is classic banking fragility, except these entities lack deposit insurance or Fed backstops. Private credit has reached approximately $2 trillion globally by some estimates, representing about 12% of bank loans to non-financial corporations, according to OECD data. Default rates have been rising, hitting 5.7% in early 2025, according to Fitch Ratings, up from 5% just months earlier. If economic conditions deteriorate, if tariffs hammer corporate borrowers, defaults could spike. Private credit funds would face losses. Investors would demand redemptions. Funds couldn't meet them because loans can't be quickly sold. Forced liquidations at fire sale prices would follow. Banks that lent to these funds, remember that $1 trillion in bank exposure, would face losses. The contagion chain is built into the structure. Third, money market funds. These seem boring. They invest in short-term, high-quality debt. But they're structurally fragile because they promise investors they can withdraw at any time while holding assets that can become illiquid during stress. In 2008, when Lehman Brothers collapsed, a major money market fund held Lehman debt that became worthless. The fund broke the buck, meaning its net asset value fell below $1 per share. Investors panicked and pulled $300 billion from money market funds in days. Only Fed intervention stopped total collapse. The same vulnerability exists today, just larger. Money market funds hold trillions, and any shock that makes their holdings illiquid could trigger devastating runs. The systemic risk isn't just size. It's the interconnection between shadow banking and traditional banking. Banks lend to hedge funds and private credit vehicles. Banks sell loans to securitization vehicles, a shadow banking activity. Banks rely on money market funds for short-term funding. When shadow banking stresses, traditional banks face losses from their exposures. When traditional banks pull back from lending to shadow entities during crisis, the shadow sector faces liquidity shortages, forcing asset sales that crash markets. Each sector's weakness amplifies the others. Regulators understand the risks, but lack tools. Shadow banks aren't subject to bank capital requirements or liquidity rules. They don't report positions comprehensively. The Financial Stability Board can estimate total sector size, but can't drill down into individual entity risks the way bank regulators can examine banks. Proposals exist to designate major hedge funds or asset managers as systemically important, subjecting them to enhanced oversight. But political opposition, often funded by the very entities that would face regulation, has blocked such measures. The growth trajectory suggests problems ahead. Shadow banking assets have grown at roughly 9% annually, far faster than traditional banking. Market research projections suggest the sector could reach $148 trillion by 2032, more than doubling from 2023 levels. This growth isn't being driven by improved risk management or better oversight. It's driven by regulatory arbitrage. Entities move to shadows specifically to avoid rules that traditional banks must follow. This creates a race to the bottom where the least regulated entities capture market share. Because they can offer better terms by taking risks regulated banks cannot. China adds another dimension. Estimates place China's shadow banking system around $8 trillion, though opacity makes precise measurement difficult. Chinese shadow banking grew explosively as a way for entities to circumvent restrictions on traditional bank lending. When China's government tries tightening credit through banks, lending moves to shadows. This makes monetary policy less effective and risks less visible until crisis hits. Given China's importance to the global economy, a Chinese shadow banking crisis would reverberate worldwide. The fundamental problem is that shadow banking performs essential economic functions. Companies need credit, investors need places to park short-term cash, markets need liquidity. Shadow banking provides these services often more efficiently than traditional banks. You can't simply shut it down without severely damaging economic activity, but allowing it to grow, unconstrained while remaining opaque, creates catastrophic risks. Some argue shadow banking is actually safer than traditional banking because these entities don't rely on runnable deposits. Hedge fund investors lock up money for months or years. Private credit funds have redemption restrictions. This is partly true, but it misses the point. These entities rely instead on short-term wholesale funding, repos, and prime broker relationships. When counterparties lose confidence, they pull funding just as depositors run on banks. The mechanism differs, but the outcome, forced liquidation under stress, is identical. The 2025 bond market chaos provided a real-time demonstration. Hedge funds had built massive leveraged positions in Treasury basis trades, exploiting tiny price differences between Treasury bonds and futures. When market volatility spiked due to tariff uncertainty, these positions unwound violently. Hedge funds had to sell Treasuries en masse. Yields spiked, stocks fell. Only when markets calmed did the forced selling ease. But the question remains, what if stress had continued? Would the Fed have needed to intervene again, backstopping entities that refuse oversight? That moral hazard, the knowledge that shadow banks get bailouts without bearing regulatory costs, encourages ever greater risk-taking. The $70 trillion figure, specifically referring to credit-focused non-bank financial intermediaries, understates the full scope because it excludes pension funds, insurance companies, and other entities that are technically non-banks but more regulated than shadow banking proper. The broadest definition, $239 trillion, includes everything outside traditional commercial banking. Either number is staggering. Either number represents a parallel financial system that performs banking functions without banking constraints. Understanding shadow banking matters because next crisis will likely originate there, not in regulated banks. Banks are stronger now, better, capitalized, more liquid. Shadow banks are larger, more leveraged, more opaque. When crisis comes, and the question is asked, how didn't anyone see this coming? The answer will be, we saw it but couldn't regulate it because it operated in shadows by design. The system is too profitable to stop, too interconnected to isolate, too large to fail, but too fragmented to supervise. That's the perfect recipe for catastrophe. If this changed how you see global finance and where real power lies, hit that subscribe button. The shadow banking system proves that the most important forces are often invisible until they fail spectacularly. Understanding what operates beyond regulation might not prevent the next crisis, but it might help you see it coming.